Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Aabha Bakaya and our guest for today, an old-timer for the Indian market, Hiren Ved, CEO and CIO of Alchemy Capital Management. Hiren, it's good to see you again. You also must be very pleasantly surprised at the remarkable resilience of the Indian market relative to all other global markets. I mean, we almost don't seem to blink these days when the US markets fall for 3 or 4 sessions on the trot. Do you think this is sustainable, or is it in a sense making the Indian market vulnerable to future drawdowns in case the global rout continues?
So first of all, hi Udayan and Aabha, thanks for having me on the show. It's an incredible how resilient the Indian markets have been. And I think it's not about what we are seeing today. We've virtually thrown everything at this market for the last 12 months, right? Inflation, rising rates, the Ukraine war, supply chain dislocations, oil at $100 plus. And despite that, the markets are just 4 or 5% away from its all-time highs. So there are two ways to look at this, right? So either you look at data and then try to support a thesis of the market, or you then look at price action and then decide what the market is doing. And if you look at the price action, what the price action is telling you is that this market is set for a very resilient and structural run. I think once some of these geopolitical issues get sorted out or settled or are priced in, you may see a significant run up in this market.
So Hiren, we take your point about the resilience, but my question is, do you see this global turbulence or geopolitics, as you mentioned, as the only headwind for this market now, or would you also add valuations to that list of things which could come in the way of this continuing outperformance?
No, Dian. In fact, I'm quite surprised when people bring in valuations in the equation, right? I mean, if you really look at the earnings in the last 2 years, in the COVID year, Nifty earnings was up about 18-19%, and then in 21-22, the earnings was up another 48-49%. Now you could argue that a large part of the incremental earnings was because of commodity stocks earnings going up, but earnings are earnings, right? And if you look at the just concluded first quarter numbers, right, I mean, despite almost a 400-500 basis point shave off on EBITDA margins, you've still had positive earnings growth in India. And the Nifty earnings have been cut by just 2 to 3%. So I think now the FY24 Nifty earnings is as about 995 or 1000, which means that we are roughly trading at about 18 times 1 year forward earnings. I think for a country which is now likely to see a secular growth in earnings and is placed fairly well in terms of the growth cycle, I don't think paying 18 times 1 year forward earnings is going to be a big challenge. And look at the breadth of the earnings revision, right? I mean, unlike in 2018, 19 and 20, when earnings were very consolidated in just a few top companies, I think what's changed this time is that a far wider set of sectors and companies is contributing to this earnings growth. So I think that I don't think the valuations are very expensive. Even if you look at it the other way, right? I mean, let's look at what the Nifty was pre-COVID. It was at 12,200 in February 2020. And the Nifty earnings in March 2020 was 440. In March 22, the earnings are at 700 plus 750, which means that the earnings are up 65% in 2 years, but the market's up only 45% from 12,000 to 18,000. So I think that, this market is very rational, and despite everything being thrown at it, the real foundation of the resilience of this market is the turnaround in the earnings growth story of India Inc.
Okay. Now, let me ask you about this global issue. I mean, when we talk about global turbulence and how it affects India, we talk about the route, the technical route, which is what FIIs will do and whether market money will go out. But let me ask you this question from a fundamental perspective. I mean, as a fund manager, how do you factor in this level of global dislocation and what it means for the globally exposed sectors like IT, pharma, chemicals, and whether you are less sanguine about those sectors compared to the domestic focused ones?
So I think, Udayan, I mean, there is clearly a case if you are investing with a long-term view now to be long on domestic sectors. And I think within the domestic sectors, if you look at the medium term, you're clearly seeing that a lot of the consumer discretionary kind of sectors, or the opening up sectors as they call it, like retail, restaurants, etc., are doing phenomenally well. And it's kind of, important that you are, positioned to take advantage of that. I think manufacturing in India, whether you play it through industrials or capital goods or whatever, I think is likely to have a 10-year bull run in my view, right? That's a huge structural growth story that we see. In exports, I think it's a little bit of, you can't make a generalization, right? I think if you are part of a global supply chain like in specialty chemicals, etc., I think you are likely to do phenomenally well. But I'm not very bullish, let's say, for example, from a growth perspective on the large IT companies, but at the same time, I'm extremely bullish on niche IT service companies which are more focused on ER&D or design. So I think in exports, you got to be a little more nuanced. And yes, maybe growth will slow down in Europe and US, and that could have some impact on exports. But there is a counter impact in terms of a greater share coming to Indian manufacturers, whether in auto components or specialty chemicals or specialized IT services. So I think it's important to be broad-based. But yes, I take your point. I think that we are more bullish on domestic demand-oriented sectors, which to us look like to be in a structural up move.
Okay, talking about the structural growth story, Hiren, let's break that down a little further in terms of the other pockets where you find those opportunities, and are they necessarily restricted to stocks of a certain size, or would you be looking across the market but for clear structural growth stories?
So Aabha, I think, again, in terms of the structural growth stories, as I mentioned, that, we're very bullish on manufacturing, right? I think autos, clearly after 5 years of very tough times, is coming out of the shadows. Specialty chemicals is in a structural growth story. Obviously, there was a high base effect and there are some raw material pricing issues. But on the whole, I don't see an issue in terms of these sectors growing at very healthy double-digit rates. Defense is a big sunrise sector, right, in manufacturing. And I think there we can clearly now see the whole Atmanirbhar Bharat and the focus on getting domestic manufacturing kick-started. We saw the recent carrier being inaugurated at the Cochin shipyard. We're seeing that more fighter aircraft are being manufactured in India at HAL. And I think that is going to spawn a whole ecosystem, just like when the auto industry came to India, the Japanese and the Koreans came, and it spawned a whole auto component industry. I think there's going to be a whole ecosystem of defense manufacturing that will do phenomenally well. So I think it's going to be spread across several areas, and you will see far more smaller companies which haven't done anything for years. I mean, like, when was the last time that people were bullish on bearing companies or tire companies in India? I mean, we had well forgotten to even hear about those stories, or even for that matter, textiles, which is coming out of the woodworks after 10 years, right? So we're seeing a breadth of sectors which are likely to do well now.
On the consumer-facing sector specifically, which you spoke about, Hiren, what's the best way to play it? Because some are playing it through autos, as you just said, But there are many smaller sectors within it that people are trying to home in on. Like some prefer the liquor industry, some prefer home building materials, some are looking at fashion and textiles, some are looking at QSR restaurants.
Yes.
What to your mind are the best pockets to play this consumer discretionary theme that you just alluded to?
So I think all of these, Udayan, that you mentioned in some measure, but I think one of the trends that we are seeing clearly is that premiumization is a big trend, right? I think what we are seeing is that the consumer at the lower end is really struggling. I mean, the last 2 years of COVID plus the inflation in the last 1 year has really dented the purchasing power of people at the lower income strata. And therefore, we are not very bullish on small ticket FMCG kind of consumption that we have been so bullish for many, many years now. That was a great story of penetration and the levers and everybody going down to the smallest of villages and selling soaps and detergents. I think the stories now move to more premium products. So yes, we are bullish on QSRs. We are very bullish on liquor, and any place where the incomes at the higher end have not been impacted. In fact, asset prices have gone up, their incomes have been protected, and therefore premium consumption is where I think you should play your bet on. And it's going to take about 12 to 18 months for incomes to be rebuilt at the lower end of the lower end of the income strata. So our general sense is that stay out from low price, low ticket kind of FMCG consumer products and move to the more premium products where consumers have pent up demand and purchasing power.
In light of what you're saying, what's the best way to position yourself in the financial landscape right now? Which kind of financials would benefit most from the kind of terrain that you are predicting?
So I think, Udayan, obviously the most obvious thing that people are playing is the large private sector banks, right? And now from this year onwards, until recently, from post-COVID until last year, the banks were underperforming. It was a sector which was not doing that well, but now this year the banks have started to outperform. But if you peel it a little bit more, I think if you want to be with the larger players, and which obviously makes a lot of sense given that the balance sheets are cleaner and the NPLs are behind you and credit growth is climbing. But I think we would play through banks which are more technology and digitally savvy, because I think one of the big disruptions that we are seeing in financial services is the role of technology, right? I mean, people are no longer going to the branches, and digital is playing a big role. So I think clearly there you have players like ICICI Bank and Bajaj Finance who are far better placed. But if you look at the price action and performance, actually many of the smaller private banks are also doing very well, and also some of the PSU banks have also done phenomenally well. So if you want to play a more cyclical rebound, then I think one way to do that is through PSU banks, though frankly we are not doing that. But I think the smaller private banks and the PSUs have performed better than the consensus play on the large private sector banks. But I think some of the areas that could structurally benefit could be everybody is doing retail lending, right? And I think that we believe that the big banks are playing a great role there. Unfortunately, I thought the fintechs will do very well, but there seems to be regulatory headwinds. But I think that playing the plain vanilla big large banks could be one way to do it, and maybe some high quality smaller private banks.
All right, fair enough. Hiren, have to ask you, of course, about some of those new age listings, and I know that you're incredibly bullish on the structural growth areas like you highlighted, but you didn't mention any of these new age companies. So is that a clear avoid? Can we deduce that from your answers, that you would clearly stay away from some of these companies, or would it be stock specific?
No, I think Aabha, there was a complete euphoria, a year and a half ago when many of these companies listed and the valuations were clearly out of whack. But I do think that, there could be some very interesting plays there, and now that prices have corrected, we do believe that there is an opportunity in at least some of them. We do have some investments. Unfortunately, I can't be stock specific, but I think selectively it's a good hunting ground now that valuations have corrected. You need to be obviously confident of the execution and the path to profitability. But I think these companies are growing at 30-35% a year, and if they can become profitable soon, I think there is money to be made there as well.
There is also a lot of excitement after a long time, Hiren, in the whole capital goods, construction, capex related space. But that's a very large field. I mean, down from the L&Ts to the power equipment makers to the road construction companies. If you had to play that theme, which path would you go down?
So I think, Udayan, the nature of capital goods spending is changing, right? It's no longer thermal power plants and road construction and so on and so forth. I don't think that the traditional EPC construction companies is the way to go, at least in our view. I think you got to be more aligned with companies that are focused on either new energy or electric vehicles or solar or some part of the value chain where they will benefit, because that's exactly where the spending is likely to happen, right? So you don't have absolute pure plays, unfortunately, in India. But for example, a company like an ABB or a Siemens or a Hitachi could be great proxies to play, because they do play in some of the value chains, either in electric vehicles or in solar. And also I think that manufacturing 4.0 is a reality where there's more automation, more robotics, which is likely to drive growth. And therefore, companies in capital goods which are more technology intensive would be preferred bets, rather than going back to just the old EPC companies. I don't think that that is the way to play the capital goods story. But there are a lot of very high quality engineering companies where exports also could become very big. I also mentioned auto components, where a lot of the companies are very well aligned to the fast growing EV theme. So I think there are sub segments within capital goods that one will have to pick and choose, and not necessarily go after the traditional names that we've seen in the past.
Hiren, good to hear your thoughts as always. Thank you very much for taking time out for us today.
Thanks, Udayan. Thanks, Aabha. Thanks for having me on the show.
If you like the video, do like, comment, share and subscribe.